Stephen Aniston was born in Sofia, Bulgaria, and immigrated to the United States in 1992. He graduated from Stanford University with a Bachelor of Science degree in Industrial Engineering in 1997. Stephen is a software architect with investment banking and alternative asset management experience. Over the past 10 years, he was technical architect for the merchant banking division at Goldman Sachs from 2006 to 2009, and investment banking technology vice president at the Royal Bank of Scotland, the RBS, from 2010 to 2012. He has also had stints at hedge fund asset managers K2 Advisors from 2012 to 2014 and Ivy Asset Management from 2004 to 2006. Since 2015, he's become a financial newsletter provider and investment advisor fully focused on systemic volatility strategies. He passed the Uniform Investment Advisor Exam Series 65 in 2016. So join me in my discussion with Stephen Aniston up next. Great, that's a cool sign you have behind you.
Yes.
Are you at work right now?
No, that's my home is my office. So.
Oh, nice.
So I put this together.
Cool, nice. Well, I appreciate you doing this, and it's been we can just talk for a second, then I'll turn the record on or whatnot.
Sure.
Anyway, it's been a great year for the VIX, huh?
Yes, it's been a crazy year for the VIX, I would say. Yeah.
August was a bit of a roller coaster for me, but besides that, I only started trading the VIX in May. So
you started this year? Okay.
Yeah.
Excellent.
Yeah. So I mean, I was a trader for many years in the SIBO floor trader, but
Sure.
the VIX was just some number off to the side somewhere during that period of time. It was not yet I left there in 2004, so it was not yet anything other than just a concept, like an indicator, sort of.
Sure. Yeah. No, that's no. I mean, it wasn't really widely used until a couple years ago. I mean, basically, a couple years ago, people like me started writing about it, started doing research on it. There's a few people, and then we kind of, I think it kind of grew organically, basically, because we were able to kind of use it in a certain way. And I think, I mean, we're just some individual traders, but also institutional people started to recognize it and started to figure out how to use it, and that has led to big growth in the space. Which really has kind of really gone up exponentially over the last couple of years.
I noticed it's gone like tenfold. All right, well, let me turn the record on so we can start talking. I hope you don't mind. I don't mind being a sort of informal. I think probably the majority of interviews you've done have been for like more fancy media than me, but I love watching Joe Rogan and the sort of informal just discussion or what interests people. And like I said when I emailed you, if we just have interesting conversation, then it's fun for me. It's fun for you. That's all that really matters to me. That I don't do YouTube for money. I just do it for fun. So.
Yeah, that's fine. That's fine.
Okay.
Exactly. Yeah.
All right. So I'm gonna turn it on. Okay, I turned it on. All right. So thanks, Stephen, for doing this. I'm really excited to have you on. I found you on Twitter a couple months ago, and I read your white paper on the VIX, and that's how I found you.
Yeah, thanks for inviting me. Yeah, so glad to be here, and to be doing this thing with you. And so tell me about the paper. What do you think, or what?
Well, I mean, it lays out the basics. When I started trading the VIX in May. And I went online to StockTwits and started trying to build my knowledge. The way I got to UVXY and trading that was I started out with looking at leveraged funds, like 3 times leveraged funds, and figuring out a way to make money on those. So I was thinking, well, if I short 2 or 3 times leveraged funds, then I can make money on the beta slippage. And by investigating that, I found UVXY, and I started looking at Contango. I knew a little bit about Contango from oil,
Yeah.
but I became aware of the actual huge amount of slippage that we're getting from Contango in the VIX products. And soon after that, I found your white paper, and I was thinking I was going to start a website, and I was looking through the different names, VIX Kings, VIX this and that, and I tried Vixcontango, and it was taken. So
Right. Yeah. I beat you by a couple of years to that, I guess. Yeah, it's a good sounding name. Yeah, I mean, basically what we try with our website is when people get into the trade, there's a lot of resources out there, like Vance Harwood, and there's some other websites where Bill Luby, they have a lot of kind of blog posts to kind of explain the trade to various people. This is a very complicated trade. I think there's a lot of stupidity out there, trying to portray all the people who short the VIX or they're along the VIX as complete idiots, because this is it's a fairly sophisticated trade, and usually the people that do it have been around the markets for more than 20 years, most of them. But basically, once you get past these sites, what my website tries to do is that people that want to get involved in it and start to trade on a daily basis, on a weekly basis. I'm in essence a volatility analyst, right? So just like you have stock analysts that tell you what their price target is for a company. They look at the fundamentals. I look at the fundamentals of this trade, and I give people kind of an advice of which direction to play on, which is the safer direction to play on. And so I provide kind of daily updates. I have a weekly state of volatility newsletter. And also on my website, I have a lot of kind of reports, a lot of data for the VIX, where I kind of put together data from various different sources. And so then people, when they come in, they're equipped to trade volatility successfully.
Well, I was watching some of your videos on YouTube, which are really excellent, not just for the VIX, but for the market in general. And you were discussing how, well, yes, the S&P 500 has gone up over the last few years, but if you were able to actually pick, a spot where you could have gotten away from the down moves just once or twice of the bigger down moves lately, you would have tripled the amount of money you made. You were discussing the down move in, I believe, 2000, 2008, and you were discussing how you could use volatility to give you a heads up as to when there might be a down move.
Sure. I mean, the way I kind of came up on this whole thing is basically a few years ago, around 2010. I kind of started thinking about investing. So, I worked for a while, saved up some money, have some kids, and at some point you start thinking about the kids, right? And so I started thinking about investing, and I just don't believe anything that anybody tells me, so I have to kind of figure it out on my own. And I have kind of a background as a software developer. I've been a software developer for many years, and back end, front end, middle tier, but kind of near the end of my career, I did a lot of basically getting a lot of data and doing a lot of business intelligence, So I kind of have the ability to kind of put data together. So I started doing that, and I researched kind of various different ways to invest in the market. And I never could really kind of find an answer. I had a very simple question: when do I get out of the market, right? I mean, markets go up. The question is when to get out, and not so much when to get in. And eventually that led me to the VIX, and basically our kind of fundamental thinking about the markets is the following: if volatility is high or is rising, the general rule is you want to stay out of the market. Basically, if the market is volatile, or if you have indications that the market is volatile, that means that there's some kind of a disagreement about the market, about its pricing, and you're going to have, you can lose money. That's what volatility is. So if the volatility is on the rise, you want to be out of the market. It's much better to be in cash or doing something else that is not as volatile. And vice versa, if volatility is high and starts to decline, that basically is a signal of volatility being realized. The risk of the market is now realized. That is a time where you want to get into the market, and you want to ride the market higher as volatility declines, as there starts to become a consensus about the pricing of the market. So this year, you can use as an example of such an event. When Trump became president, there was a huge disagreement about what his potential impact is going to be, right? Some people thought he was going to tank the market. Other people thought he was going to be great for the economy. There was a wide disagreement. The VIX was high, right? But the VIX peaked and started to decline. So what that was telling you that people were starting to change their minds about Trump. And so now a year later, everybody loves his agenda. Everybody loves the infrastructure bill, the tax plan, and everybody, they look out for the next 10 years and they think it's going to be great, right? Now there is a consensus about what Trump's effect on the market is going to be, and consequently, the volatility readings are at all-time lows.
Well, I really messed that one up. I took basically all my money out of the market right before Trump was elected. And, you shouldn't vote with as a trader, you certainly shouldn't vote with your trades. And I wasn't necessarily voting with my trades, but I just had this feeling like, oh no, I can't live with myself if I'm really long and Trump comes in, the market crashes or something. But my father's been giving me a hard time ever since, because it was a huge rally and it's sort of rallied ever since. Many of the guys I hang out with on StockTwits are pretty sophisticated, and like, for example, the average guy I hang out with can picture in their head the term structure of futures, and knows what the front month future would be and the second month out future would be, and they know that the composition of, for example, UVXY is a blend of those two futures. And so they're fairly sophisticated. And so when I came upon some of the information you had as far about the term structure, and that was fascinating to me. I've been exploring the relationships between the front month future, the second month future, and then their relationship to spot for a while. Now, I wasn't familiar at first with the indicators that you have arrived at, the VCO and the other one, but I was like in my head examining those relationships over time and seeing how they functioned as the markets changed.
Sure. Yeah, the Vixcontango oscillator is kind of a one measure that I put together, which basically combines the VIX with the VIX futures. Now, it's important to understand that these are two different markets, right? The VIX is a calculation off of the S&P 500 option market, right? Which is a large market where people buy puts and calls, and it's primarily large institutional investors. And the VIX futures market, which is also to a large extent large institutional investors, but it's a much smaller market. So the VIX futures market, the VIX futures market basically was there as a trade, even beforehand, and basically, the so-called vol swaps that, they've been around since like the 90s. And then just over the years, it became a bigger and bigger market, and at some point they created a marketplace for it, right? Now, the whole infrastructure that supports the VIX futures market is still there. There's somebody that determines the price of the VIX futures, right? So there's somebody that's trading a portfolio of options that looks like the VIX versus the VIX futures, and that's how they kind of adjust the price correspondingly. But basically, to me, it was very important to look at the totality. So for example, as a signal, a lot of people would just look at the VIX, or they just look at the futures, right? So for me, it was important to put together an indicator that combined both markets to kind of harvest the intelligence of both markets. And basically, the VCO is kind of looks at the Contango, looks at the spot VIX level, and comes up with one number, which very easily tells you whether it's an oscillator that moves up and down. And basically, if it's above zero, it's a good time to be in a trade. Basically, there is a spread. There's a Contango spread to harvest, and also the VIX is high enough that will allow you to make money. But also, if the VCO becomes negative, that means either the Contango is negative or the VIX is very low, and thus subject to mean reversion, which then would render a short volatility trades a losing proposition. So basically, it kind of helps you to evaluate that. But this is one signal that we use. So on our website, we look at a number of signals. So we definitely look at the volatility term structure. So the Contango, which is the spread between the first and second month future. The row yield, which is the spread between the spot price and the first future. We have an indicator called Contango row, which is the spread between the spot and the second future.
I was looking at that yesterday. Yeah, Contango row. That's interesting.
Yeah. So some people look at the synthetic 30-day VIX decay. Basically the difference between the spot and the synthetic 30-day VIX, which is basically what the XIV and the VXX track internally. But this is not the only type of volatility indicator we look at. We also look at, for example, volatility momentum, which is kind of a trend following momentum, how far you are from the 10-day moving average or the 50-day moving average, right? This volatility is a trade that has sudden bursts of momentum. And then the momentum can override the term structure, right? So if the VIX starts to go up higher, you may have Contango, but tomorrow you're not going to have Contango. As the VIX goes higher, the entire curve moves higher, right?
Now, is that the sorry to interrupt you? Sorry to interrupt you. Is that the momentum of the future?
That's the momentum of the VIX itself.
The momentum of the VIX itself. Okay.
The momentum of the VIX itself. So then there are also, we look at the volatility risk premium. A lot of the websites out there that sell signals, they basically are based on volatility risk premium, which is the spread between the historical volatility of the S&P 500 and the expected volatility, which is the VIX, right? So the theory there is that the historical volatility is below the expected volatility. The expected volatility has to converge down, has to come down over time, and therefore that is a profitable short volatility, profitable signal for short volatility. We also look at kind of the volatility speed, the volatility of volatility, right? How much does volatility oscillate?
The VVIX.
Yeah. The VIX, yes, exactly, the VIX. But the VIX is expected volatility, so there's also measures of historical VIX volatility, such as the VIX ATR, average to range, or the VIX historical volatility as well, right? So you can calculate a historical volatility on the VIX, and then we also look at kind of volatility exposure indicators as well, which is basically look at the ETF market, how much AUM there is in long volatility ETFs, short volatility ETFs, right, to see kind of the positioning of players in ETF space. So we look at a wide variety of signals to kind of determine what we do. So at some point, we do have a couple of signals. We do have a couple of portfolios that are algorithmic, that they use a number of these signals. It's not just one signal, because basically, if you try to use one signal, that one signal can be gamed, and there are periods of time when that signal is negated. So the market always moves to a place where it can confound any individual signal. So usually the best way to kind of put together successful strategies to combine the signals. So you got to look at 5-6 signals and then combine them.
Who would you say the average customer of yours is on your website? Is it a fund manager? Is it an individual investor? Is it a somebody who only trades the VIX? What would you say?
As part of my service, I do provide kind of a market outlook. So I do cover other ETFs kind of on occasion as needed. I do provide a broader market outlook. I also provide analysis of all kind of current events. So when people sign up, they have a pretty good idea about what's going on in the market, right? So again, I'm kind of like an analyst, you know. You have a tax bill, what is the effect on the market of the tax bill? So I look at the tax bill and I kind of try to come up with pricing. What does that mean for the S&P 500? What does it mean for the VIX? What does it mean for the different sectors? So people get that as part of the subscription as well. So the type of crowd that we have, a lot of the people that are my clients are former financial, you know, there's a lot of managing directors from financial institutions. You know, again, this is a very complicated trade. You're talking about like 5 to 6 levels of derivatives. You know, you have the S&P 500, which is, you know, a basket of stocks. Then on top of that, you have options. On top of the options, you have the VIX. On top of the VIX, you have the VIX futures market. On top of the VIX futures market, you have the ETFs. And some people do options on these ETFs. So this is 6 levels of derivatives. Yeah. And, you know, for most people, you mentioned the word Contango. Like even if you take just your regular registered investment advisor, you'd say the word Contango and their eyes start to glaze over. This is far too much, you know, technicalities, financial technicalities. So it's a pretty involved group of people. So they're usually MDs from financial institutions. Some of them are CEOs of corporations that are with a very technical bent, like you know, they're engineers and of various sorts. You know, there's investors who are just interested in volatility, but you know, a lot of the people that they interact with are basically highly skilled professionals. You know, people that know a lot of math. You know, they're either architects or financial people or accountants or insurance executives. These types of people.
Yeah, I noticed that the trade has gone. I was looking at one graph that from 2010 till now, it's gone up tenfold in the amount of volume in the VIX futures. I was interested when I was watching some of your YouTube videos to find out exactly how much the S&P is of the total trading in the world. It seems like it's like about 80% of all the trading in the world is the S&P 500. Is it somewhere around there?
That's right. The S&P 500. I mean, basically, you know, this is type of stuff that, like, you know, if you watch Jim Cramer, you know, he's a fantastic guy. But like, if you watch him, he basically tells you to go and invest in various stocks, right? And a lot of them have basically zero liquidity. If you ever worked in finance, you know, where basically you make money out of handling assets, right? The size of the assets. The market is just basically, you know, you have the dollar market, then you have the U.S. Treasury bonds, which is, you know, gigantic. So each one is order of magnitude smaller, right? So then you know, which means 10 times smaller. So then you have the bond market, and you have the stock market, which is 10 times less. And when I say stock market, I mean S&P 500 futures. And then after that, you have the individual stocks. You know, you have like the big ones like Apple and, you know, Bank of America and Google. You have a few of those that have a lot of volume, and then after that, it just drops off. It's basically, you know, it's basically free for all. You know,
it's a risky proposition, huh? Buying an individual stock. To me, it's like a 50-50 shot whether it could go up or down. I mean, for an individual just to buy an individual stock, it seems very risky.
Yeah, I mean, you know, I used to, one of the companies that I used to work with. I worked at a couple of companies that used to invest in hedge funds, right? So this is basically pension funds, various wealth funds, various foundations like Harvard. You know, they invest in these companies, which then allocate money to various hedge funds, right? So they would get their exposure of the market through the hedge fund. The idea being is that, you know, you invest in the best managers, right? the way these people think of the market is they don't think of it like, oh, this stock or that stock. They think of it, okay, do I have exposure to Asia? Do I have exposure to US, right? Is it US equity exposure? It's basically asset allocation. And people didn't used to have the ETFs have grown a lot now, so people are switching over to ETFs now. But before that, if you want exposure to the US market, you get a hedge fund manager that gives exposure to the US market. But in general, they're also kind of, when I was working at that place, when you look at the hedge funds, it also did a lot of reporting. So people actually would buy individual stocks. What basically happens in industry is people buy individual stocks for the dividend. They'll buy G or they'll buy Dow because they have high dividends, right? And they'll hold the stock. People really don't like to sell stocks these days, right? Because they have a good dividend, especially in a low interest rate environment. So what they do instead is they hedge, right? So they buy portfolio hedges. So they hedge the entire portfolio. So if you have a market drawdown, they have a hedge that basically alleviates the volatility of the portfolio while they keep collecting the dividends, right? So that's basically what majority of the hedge funds do. And that's why this market exists. That's why the VIX exists. That's why it's such a big market. And as these hedge funds need to buy hedging, somebody has to be on the other side to provide hedging, right? So this is the short volatility trade, which as the need for hedging has increased, right? And the sophistication of the tools has increased, that market has grown bigger. So now you have tools for, this used to be a market which only other hedge funds and institutional, basically bank desks used to play, or proprietary desks used to play in, and now you have ETFs, so people, like you and me can participate. And the thing to understand about the short volatility trade, it is, or the long volatility trades, they are related to the S&P 500, but they're highly leveraged, right? So they provide 3 to 4 times the return of the S&P 500. So this is a trade where if you're wrong, you're going to blow very quickly, right? If you're not an active trader. But then at the same time, if you're on the right side of the trade and it goes well for you, like this year, you can make an astounding amount of money.
I want to ask you a question which I asked Vance when I was talking to him a couple of days ago, and I want to ask you the same question, which is, we know that the notional value of the S&P is huge, and that the put buying in there is what dictates the price of the VIX. Now, with the advent of all these ETFs that short volatility, whether it be XIV, ZIV, UVXY, or just the straight out futures trade or the VXX, is it possible that that there's so much trade in some of these products that they're actually able to affect the market more than the S&P at times? I mean, is there, for example, every day at 4:30, a lot of these funds have to roll from one future to the other. Is there a possibility that the cart could be pulling the horse at times, where the volatility trade is actually having higher volume than the S&P options, or is the options just completely dominate everything?
Yeah, well, I mean, the first thing, kind of myth that I want to dispute is that there is a rebalancing that happens at the end of the day. That there is a rebalancing happening throughout the day, right? So basically the way all ETFs work, this is not just something particular to the volatility ETFs. This is particular to all ETFs. Basically, what an ETF is there's a formula, right, which provides the net asset value, right? And then you have authorized participants, which is basically banks, whose job is to keep the market price closely tied to the net asset value. So what happens a lot of times is, let's say, there's a lot of demand for this ETF. So the price would deviate from the NAV. At that point, you're going to have these authorized participants. They're going to kick in. They're going to start taking the other side of the trade and try to bring the price down within the NAV. And, they have, basically, they're authorized to create or subtract shares from the market from the ETF in order to accomplish this, right? So basically, these ETFs, they don't do all of their rebalancing at the end of the day, right? I mean, that's a little bit of a myth.
Okay.
And people keep kind of floating that myth, and they think that, oh, if you have a big spike, everything is gonna crash. Has it happened already? I mean, we had 2015, we had some pretty big spikes the last couple of years. People forgot in 2015 you had the XIV lost like 50% in a few days. You had a $1,000 drop on the Dow overnight.
Or like Brexit,
or Brexit. These ETFs didn't. I mean, I actually want to talk a little bit about that. I think there's a lot of mythology here that is completely unfounded. I don't know why these people do it. But basically here, the first myth I want to say is, like, if the VIX doubles, these ETFs are going to go bankrupt. So that's the first thing that just outright wrong, because what you trade in a volatility ETF is you don't trade the VIX itself, you trade a 30-day synthetic VIX future, right? So this is VIX 30 days out. So that moves a lot slower than the VIX, right? So the beta of the 30-day VIX future is about 45%, right? So in other words, if the VIX moves 1 point, the 30-day VIX futures would move half a point, right? So in order for you to get kind of an 80% or 100% spikes in a 30-day synthetic VIX future, you need a 220% spike in the VIX. So the VIX has to go up 220% for you to get 100% there on an average beta, which is 45%. When you have a very sharp spike in one day, like for example, you go from 11 to 16 in one day, which is a large spike, 60, 70%, 50, 60%. What happens is, because the spike is so sudden, the volatility traders don't immediately, they're like, well, that's something like, that's something that's going to go away quickly. This VIX spike, this gigantic VIX spike is not going to last more than a few days, right? So what that means is that the price of the 30-day VIX futures, so the front and the back VIX future, doesn't move as much. So on these giant VIX spike, the beta of the 30-day VIX future is around 35%, right? So it's actually even lower. And actually, in order to get this thing to collapse in one day, you would need an even bigger spike. You probably need a 250 to 300% spike of the VIX. So it needs to go from 11 to like 33, right? There is only one time in history when there has been such a spike, and that was during the October of 1987 crash.
I was going to say the 87 crash. Wow, yeah.
Yeah, the 87 where it went down 22%, right? That is the only time where the VIX went from like 20 to about 120 or so. It went up like 4 or 5 times.
Wow.
So that would have crashed these instruments.
I noticed recently when we have a spike that is the case. Like when we spiked to when UVXY went to 17 about a week and a half ago, you saw the roll yield went inverted, and this speaks to that excellent video you have that has 4 different structures or shapes of the term structure at different times for different events. But basically, the futures guys, it seems like they don't want to bring the futures up all that much because they're anticipating it's going to be coming right back down pretty soon. So you'll see that you might have had, like, in normal times, the roll yield of like a dollar or something, and all of a sudden it goes to even, or it goes inverted a little bit, and
Sure.
the roll yield kind of like absorbs a lot of the move as opposed to the futures.
That's right.
And so that's I did notice what that's definitely true. Yeah.
So yeah, I mean, if you want to talk about a little bit about this, the kind of the volatility curve formation. So there's a lot of people there try to say, oh, the VIX cannot predict, and I don't think the VIX is a predictive indicator, but the VIX is an indicative indicator. I think a lot of people spend a lot of time trying to predict where the market is going to go, And a lot of times, all you need to do is just know where you are right now. Actually, if you look at kind of the way analysts make their projections, you should actually doubt that they know where we are right now. I mean, they're not even capable of looking at the present, much less predict the future. So what the volatility curves basically, there's four formations. So if the volatility curve is kind of downsloping, right? So the volatility curve combines the spot VIX, so it combines the VXXT, the VIX, the VXMT, or they call it now VIX3M, and the VXMT, which is basically the 9-day VIX, the 30-day VIX, the 60-day VIX, and the 6-month VIX. And then you put this together with the VIX future. So basically you get information from the S&P options market, right? Various durations, options of various duration, and then you get the VIX term future. So you combine this together, right? And on the front side, you have the VXXT, which I think is a very important indicator, the VIX, the VX1 and the VX2, right? So you have the front, and then you have the kind of the middle of the curve, right? So generally, if you look at kind of the front curve up to the VXV, up to the 3 month, that should give you a good analysis over the next 3 months, which is basically what the market knows, right? The market can't really predict what's going to happen more than 6 months out or more than 3 months out. That's there are just too many factors in play for anybody to credibly predict what's going to happen a year out. So most of the time you need to focus on next quarter or next 2 quarters at most. So if you look at that shape of the curve, when it's basically downsloping, we call that a rally formation. What that means is that the way VIX futures are priced, there's maybe I should mention a little bit about the Contango, or where the Contango comes from, because the Contango in the oil markets, as you all know, is basically storage cost. The Contango in the VIX market is a completely different concept. It is basically the VIX is a mean reverting index, so it's assumed that it's going to go to the mean over the future, in a long-term future. So the VIX, the 8-month VIX future is usually fairly close to the average VIX of at the time, right? So the average VIX right now is about 19.5. So the long-term VIX future is usually pretty close to that. So then as you get closer, this starts to get steeper slope, almost like a time value, time value chart, theta decay chart. And basically you can kind of arrive at what should be the price of a VIX future by just taking the VIX, right? The number of days to expiration of the VIX future, right? And then the VVIX, right? The volatility. So the higher the VVIX, the higher it will be the future. The lower the VVIX, the lower it will be the price of that future. And conversely, if the longer time to expiration, it will be higher, right? So that's where the contango of the VIX comes. And basically, in normal market conditions, the VIX is expected to be high. If the VIX is low today, it's expected to be higher later, because just the market volatility is on average, a bigger number. So usually the curve is in kind of a contango formation, or what we call rally formation. If you start to see creeping uncertainty in the market, basically what people do first is they start to hedge their near-term exposure to the market, right? So then the VXXT and the VIX starts to go up, right? And it starts to even out with the VIX, or starts to lead the VIX so that's what we call the drawdown formation. So when people start to panic, the front indicators start to kind of flatten out and start to move up. Then as the panic kind of develops, then at some point people start to panic and they really start to buy puts. So then the VIX spikes up, the VXST spikes up a lot, or the futures kind of trail behind. So people are starting to tell you, well, in the future, things are not going to be as bad as they are right now, right? I mean, we don't think this panic is going to continue. That sometimes that is most of the time that is a very good signal to when the contango, when the curve goes from contango to backwardation, that's usually a good time to buy, to kind of short the VIX, right? And a lot of people use that.
To start a position maybe, or add to a position there. Okay.
Right. However, sometimes this can backfire, right? And the VIX can continue to go higher and higher as the market panic continues. So whatever people thought was, the end of the panic is not, and then you really get big losses. So this trade, 80% of the time you're gonna make a good trade, and then like 2015, you're gonna overstay your welcome by a couple of days, and it's gonna cost you another 50%, and you're gonna lose, the money that you've made over a couple of years, you're gonna lose in a few hours. So this is the risk of this trade. It is a very beneficial trade until a day comes where you make a mistake about the severity of the problem in the market, and that's this is one thing about the markets that, if you've been participating in them for a while, everything comes at a cost. If you have high profitability, there is a reason for it, and the reason for it is that you're taking an enormous amount of risk. So if you see a trade that gives you exceptional returns, that means basically the market is compensating you to take an extraordinary amount of risk.
Yeah, nothing comes for free out there. People like to say that, like, well, this is some trade or another's a layup. If someone's giving you a layup, you're not understanding the exact situation probably, because there's a price for the easy money.
Yeah, I mean, just to speak for the last like 6 months, when basically the VIX has averaged, a lot of, single digits, has spent a lot of time in single digits. The monthly average has been 10. Prior to this year, we've had like only 2 months with a monthly average of 10, like November and December of 2006. So this year we basically had an entire year of that. And that's why the returns have been amazing, because basically the VIX futures market, people that have experience with this trade, they just say that's not something that's sustainable long term. So it has been sustainable for 6 months, but that's not something that's historically been sustainable. So a lot of people just would not want to take the risk. So then you have traders that, oh yeah, this is like totally normal, right? So they jump in, they've made money, but anybody with experience would not be taking that risk, and that's why the returns are high.
So there will be another spike again sometime, in your opinion?
Yeah. So I mean, if you wanna, I can kind of, do you want to kind of go over why this year has been such a low vol, or maybe?
Yeah, I mean, when you were talking about how, like, historically the S&P has a certain volatility, and right now the VIX is a certain place, we have been in a lower range than the historical volatility of the S&P in this year. Is that correct?
That's right. Yeah.
So does that mean that this is just not a good time to have this trade on because we anticipate it going back to the mean, or is it still a chance to have this trade? Does it still make sense to have this trade on to some extent?
So to answer the first question is, I'm not a fortune teller, so I don't know exactly how this low volatility regime will end, right? I can tell you how it has ended in the past. Like in 2007, in 2006, you had a similar low volatility regime. It ended in February of 2007 with a 60% spike. So,
really? Wow.
The biggest spike ever was on February 27th of 2007. This was way before the financial crisis. You had a 60% spike in the VIX, and the VIX went from like 11 to 16. And if you had an XIV at the time, we would have lost 30% in one day. And then what happened afterwards, the XIV never recovered. So basically the VIX went up to 16 and stayed at 15 and 14, and then continued to increase, right? And increased steadily for the entire years. And so the XIV actually in 2017 would have had like a negative 60% year. We basically lost more than half of the value with no chance to get your money back. There was never
no. Was there any the day before that spike? What was it like? Was there any indication? Could anyone have figured it out that was going to happen, or it was just business as normal, just everything's fine, and then you wake up in the morning and it's a spike?
UVXY morning spike. There's no indicator that could have predicted that spike.
Because that's like my nightmare.
that is your nightmare. Yeah, and that is basically what the market tends to do is lure people into complacency. It beats down a trade long enough, it goes to a crazy place long enough it does it for months to lure people into a sense of complacency, and then when they strike, there's just no exit. So this is the danger right now of this regime. Now, so what happened in 2007, as people forget, is that the VIX went up and the market went up at the same time. The VIX and the market went up at the same time. So this is not something we've observed for the past, few years that the XIV has been around, since 2008, right? I mean, it's been a long time since we've had a real kind of bear market or anything like that. So people have forgotten, but basically the VIX does tend to move higher. Volatility tends to move higher. So basically the people in the VIX market are telling you that there's a discrepancy in the value, in how people perceive the valuations of the market, right? So there's a disagreement.
Up, yeah.
Something is up, and then eventually the market collapses. So this is not something that happens in one day. People, at this very moment, this is something that happens over a period of months, right? So if the VIX, average VIX, starts to grind higher for a period of VIX, that's usually an indication that the bull market is near an end, But again, having said that, the market, doesn't move high. So this is one example of 2007, which only happened for 1 year. An even better example, which is the late 90s. So for example, the short volatility trade became, if it had been around, right, was a losing trade for 3 straight years. I mean, basically the VIX went from like 15 and 16 in 95 and 96 to about 23, 24.
Oh, wow, really? Wow.
97, and then it stayed like 25 and 98, and then again 23, 99, and then, average. So average very, very high values for a 3-year period. And basically what happened then was, at some point...
Was that the tech bubble?
That's a tech bubble. At some point, basically the valuation of the market... there was a fundamental reason. Earnings were growing a lot, so people were kind of forced to be in the market, but at very high valuations. So anybody who is a professional knows, like, if I'm paying, 30 times or 40 times trailing earnings, this is a high price to pay, and then they will take corresponding hedges because they don't know when this thing is going to end. But they're forced to participate, right? So usually what happens at that time is people augment their downside. They are in the market, but they also buy call hedges to capture upside, and they buy downside hedges. So they start to use options more proactively and try to stay in the game while the market is just going up for no reason, or for, or its valuation is high. And then, so that actually happened for 3 years. So the short vol trade would have been a losing trade for 3 straight years, while the market was, cranking out 20% gains.
That's amazing. That's unimaginable by us. Like, if you ask somebody today, they'd be like, well, that's not possible. How could that be possible? But it happened. That's amazing. I didn't know that.
Yeah. So then you had the recession from 2000 to 2003, where you had even bigger spikes. So actually, the short vol trade was a losing trade for 6 straight years.
Wow.
Like if you had an XIV, it would have been like VIX is today. It would have gone down, it would have split, it would have gone down again, and you've had this thing for 6 straight years.
Wow. Yeah. I went to that site, VIX Central, and looked at like the term structure way back then a bit, and it's all over the board. It's like here, it's like it's all over the place, and it would have been impossible to put the strategies we have on now at that time.
I mean, most of the money in the trade is basically from Contango, from harvesting the Contango roll, right? As the futures come down, if you get into a situation where the curve is flat and the VIX is moving up and down, then basically there's no gain from Contango,
right?
right? So there's no gain from Contango. So basically your only gain is from trading the VIX, or getting out at the right time. And, that's basically where your gains go. So you don't have a built-in tailwind that you have during, that you have right now. One thing kind of I wanted to kind of explain, about the kind of low volatility regime, because again, this is something that just it's almost nauseating to hear people confusing the cause and the reason, right? Because we have this instrument now, it's like people think that volatility kind of drives everything else, right? Volatility is basically just kind of an indicator, it's a secondary indicator, right? It's a derivative indicator. It is not the primary indicator, right? The primary indicator is still your your basic fundamental analysis of the market. Are earnings growing, right? Are interest rates low? Is the overall environment supportive for investing in stocks, right? So these are the things that, and by the way, the indicator, so people kind of I've looked at various different indicators, GDP growth, employment growth, the indicator that is most closely related to levels of volatility is earnings growth, right?
Oh, really?
So if earnings grow a lot for companies, right, volatility tends to be low. And I could just kind of explain very simply, like imagine you have a house, you bought a house for rent, right? And imagine you get a rent. So you have a house that's 100 grand, it gives you a rent of 10,000 per year, right? Well, imagine that rent goes up 20%, it goes up to 12,000, right? I mean, are you willing to sell that house for a cheaper price? No, you're not, right? It's in fact, you're going to want a higher price for the house. So basically, when earnings grow, selling pressure disappears from the market. Like nobody wants to sell their stuff because intrinsically it earns more.
Really?
So
that makes sense.
So that's why volatility gets suppressed. Now add to that what happened this year. This year we had a record low volatility, and the most often comparison is 1964. What happened in 1964? You had a gigantic tax reform by JFK. Actually, it was Samuel Lyndon Johnson, but you had generational tax reform, and at that time the market did the same exact thing. It just knowing that the rates are going to come down, nobody ever sold anything until the bill was passed. So we have the similar behavior now, right? I mean, everybody knows the earnings of companies are going to grow after a tax cut. That means that the shares are more valuable, right? And so nobody's going to sell. So that's why you have this uninterrupted rise. So there's one other thing when which is kind of with valuations. When earnings grow, the market tends to assume that this growth is going to continue next year or the year after, right? So it tends to also blow up the valuation, the multiple. So you have high earnings growth of 20 to 30% is related to P multiples of 20 to 30 trailing multiples. If you have a lower growth, right, 10%, the average growth, 8 to 9% per year, multiples usually come down a lot, 15 to 18%. So the multiple of the market is related to the earnings growth, right? So imagine you're in a situation where both your earnings are going to grow and then your multiples are going to grow, right? I mean, there's no selling, right? That's what we saw. That's what we saw last year. Now, could you have predicted that earnings are going to grow 20%? A lot of people thought because of Trump that was not going to happen, right? That he's going to, start trade wars with China and so forth, and earnings are not going to grow. The actual reality was slightly different. There's basically was a capital spending that was postponed. There were really two factors. There was capital spending that was postponed for many years. Basically the last 2 years of any regime, people don't do capital investment because they don't know what the tax regime for the next few years is going to be, right? So they postpone their decisions. We're talking about big businesses. Then after you have some, regardless of who wins, right? Then the wallets open up. So this would have happened if Hillary was elected or if Trump was elected. It didn't matter. The capital investment that the economy got. So that's one thing. The second thing is, which really actually boosted the earnings of the market was the recovery in energy earnings. And the reason for the energy kind of oil crisis of 2015 was really geopolitical, right? So I often say, like, you got to watch politics to invest, which doesn't mean that you need to invest with your politics, right? In other words, don't go away from the market, investing market, because your guy is in power, right? But you have to watch politics to invest in the market. So what happened with kind of at the end of the Obama regime is, by not confronting ISIS and reneging on the kind of the petrodollar obligations of the U.S. to provide security in the Middle East, you had a very efficient oil market, right? Basically, Saudi Arabia went head to head against the U.S. U.S. producers, and they drove the price down lower. So you had a cartel that was broken, and you had efficient markets,
and
right?
Plus the fracking. Increased
you had efficient markets, and the price. You have efficient markets, and the price go down. Now, as soon as Trump came back, right, basically he corrected the foreign policy mistake by Obama, right? So now again, the U.S. is in cartel with Russia and Saudi Arabia, and they curtailed production. They're coordinating together, and as soon as Trump got power, you got the oil price went from 25 to 50. I mean, within a few months. So that in turn, the earnings of the energy sector were negative in 2015 and 16. All of a sudden, those negative earnings go from negative to positive. That also contributes to the high earnings growth that we saw this year. And that's a factor that's not a permanent factor. That was a one-year factor that's not going to extend into next year.
So if I can put you on the spot for a second, as far as what's going to happen now that the tax, let's assume the tax cuts go through. Some people say, okay, the Koch brothers no longer need Donald Trump now, and his usefulness is over. What do you think happens politically now that the tax cuts are through? Because it's been such a focus of political life in the U.S. for the last 6 months, and also for the market. I wonder what the next big subject is going to be, what the next big catalyst will be.
For what? For
the market
to go up or to go down?
I'm not sure. The other thing I wanted to ask you is, what happened in 1964 after the tax cuts? Did the market continue to rally, or?
It did, yeah.
Okay.
It continued to rally for a long time. No, tax cuts have a very mixed record. There is let's talk a little bit about kind of politics and kind of what I think about that stuff. There's basically the kind of the movement inside of the Republican Party that basically they say, oh, if you lower taxes, you have growth, right? In the economy, because people get to keep more of their money and so forth. And all of these people basically, the tax cuts of the 80s basically coincided with a demographic explosion, right? Of the baby boomers coming to the workforce, right? So regardless of what you did on taxes, you're going to have a lot of growth in the 80s just because it was a demographic explosion. So a lot of people confuse the demographic explosion with the actual policy. You would have had growth in the 80s regardless of the tax policy, right? As a matter of fact, under the Carter years, I mean, Carter is much maligned, but if you look at the Carter years, the market was up nonstop. He's the president that generated the most amount of jobs per year in office. And he left corporate earnings at a high. So actually what happened after the tax cuts during the Reagan administration, corporate earnings and the economy went into recession after the tax cuts. For 2-3 years. Then he had another set of tax reform in 86. I mean, corporations didn't get back to earning the same, the same amount of earnings as they had during the peak in the Carter years of '79 until 1988. It took them 10 years to recover their earnings after the Reagan. We're talking corporate earnings, right? We're not talking about the economy. We're talking corporate earnings. Big problem at the time was obviously inflation, right? That was a big was taking bite out of earnings, which, by the way, could be a risk right now as well, right? If you do tax cuts, you do have a lot of inflation coming out of it. So similarly, during the Bush years, right? We all lived through it, right? You had tax cuts. Did they result in the 4% or 5% or 6% growth? Did they result in budget surpluses? No, none of that stuff that was promised at the time actually happened. I mean, the Republicans keep kind of repeating these points. It is a good idea to give tax cuts and make people's life easier here and there. There's policies that do make sense. But I think the policy right now that they did is a radical policy, and I don't think it's going to turn out the way they think. So the big issue with corporations is you got to understand corporations. There's this kind of theory that corporations make this amount of money. You give them a tax cut, all of a sudden they grow earnings. Well, I mean, if you're in a competitive market, right, what's going to happen? The first guy that's your competitor is going to lower prices, right? I got a tax cut. I mean, I don't have to sell this for $20. I'm going to sell it for $18, right? And then everybody follows suit. So basically, the advantage of the tax cut gets competed away.
Right.
Through competition.
It really depends on what they actually do with the money.
Yeah.
They're not necessarily creating a job with it. They're not necessarily creating earnings with it. It really depends on exactly what they do with the money. I would say.
Jobs are not going to be created. For basically for repatriations, for where you get like a big pile of cash, right? You're going to have dividends and buybacks with that pot of cash, right? That's that's standard operation. You get this money, you give, but the rest of the money, right? The rest of the money basically is going to get competed away. And this theory would be fine if companies were not earning money. They needed a tax break to basically have higher profits. Companies are now sitting at record profits. I mean,
yeah, it's not. Yeah, they're getting a giveaway when they're doing great. It's like
way above their operating expenses. So that's not an issue. I mean, nobody's going to change what they do. People invest when they see an opportunity for a business. They don't invest because of the tax rate. That just I've never met anybody that has started a business because of the tax rate.
I want to ask you a little bit about your career, because I think it's fascinating, and a lot of people wonder how someone would get to where you are, what the path is. And in a sense, you had a little bit of a similar path to me in that I came into the trading world via IT to some extent. Mm-hmm. But I noticed you went to Stanford.
Yep.
Probably one of the top school in the United States, possibly. Why did you choose Stanford to go to?
Well, it was kind of probably the best school that accepted me, I guess. I basically at that time I lived in Oregon, and so basically got accepted to all kinds of West Coast schools, UCLA, University of Washington, University of Oregon, Stanford. Stanford was the best school of the bunch.
It's funny. I was telling you before off the air that several of my coworkers at my side job are Bulgarian, so I spend a lot of my time sort of sitting on the side as everybody speaks Bulgarian and being the token American guy in the room. So I had hoped to escape that today with the interview, but I'm faced with another Bulgarian, so it's I feel very comfortable because I love my Bulgarian friends. We have a great time together.
But we're not that very many. I mean,
Well, I promised them that I'm going to study Bulgarian this winter to learn a little bit, and I did do some studying yesterday. I was reading about Tsar Boris and Cyril, and learning about the alphabet.
Sure. Yeah, the
and
Cyrillic alphabet. Yeah.
and so I'm gonna learn a little bit. I guess it said there was 6 million people that speak Bulgarian, so
Yeah.
that's a decent amount.
Yeah, there's about like I think 500. In Chicago there is a lot of Bulgarians. It's like 500,000 people. I mean, there's kind of a sizable population in the U.S.
So what brought you to the United States from Bulgaria?
Well, I've always kind of liked the United States. Of like the system of government. Bulgaria was when I came here. That was um, very early '90s, so it was still kind of communist at the time. It had just opened up, and at that time there was kind of a massive migration. A lot of it is people wanted to send their young kids to kind of learn about you know uh, the Western culture, the Western economy, the Western way of life, right? That was not something that was possible before the '90s. So a lot of people kind of send their kids here. So some of those kids went back, right, and brought some of these Western values with them. I think that country is a lot more Westernized uh, today than it was back then. And then so some of us, stayed here.
So what was your impression of Stanford? Did you enjoy being there?
Yeah, no, Stanford is a great school. It's a fantastic school. It's obviously amazing people. The most amazing thing about Stanford is the people that go there. I mean, when at the same time with the people that started Google, that started Yahoo, um, the 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 chief technology officer of Facebook was a fraternity brother of mine. Mike Schrepfer. So they're just amazing people. Not everybody is going to be as successful as some of these individuals, but they're just there's so many smart people. It's just a privilege to be with them. I think.
Was it a largely international crowd at Stanford?
And well, Stanford is about, at least at the time, was 50% Californian. The international population was about probably 10%. There was not a lot of international people. I mean, there were some, but not a lot.
So you majored in engineering?
Yeah. So I majored in industrial engineering, which is um, basically learning about manufacturing plants and how to optimize them. And the way I think is basically in terms of, I think a lot about in terms of kind of centralization, decentralization, right? Centralization brings with itself efficiencies and faster throughput times, but also less points of failure, right? So in other words, more volatility, more gigantic volatility. And then, decentralization brings with itself more stability, but also slower processing, but also a lot less volatility, right? So for example, you see what's happening with Bitcoin now. They can't kill it because it's a decentralized system. Basically, it's a system of computers that can be anywhere in the world. You try to shut it down in the US, they actually tried to shut it down in China last year. What happened is, China and South Korea made Bitcoin, official, and then the price spiked even more. So there's 260 countries, 200 countries in the world, right? All that the Bitcoin network needs to operate is just a couple of countries where it's official.
Well, I'm gonna get to the Bitcoin and Litecoin and cyber currencies. I just want to stick with your career just for 1 second longer here. So you went to Stanford. So when did your interest in the markets begin?
So I had I kind of had interest in the markets. Then while I was in college, I was a computer assistant at the Stanford Business School. There again, a lot of famous people went through. I was helping them with their computers, but I had kind of interest in the markets at that time. They didn't really invest a whole lot because I didn't have money to invest. But I read a lot. Then later on, I went into a startup. So then for 3-4 years, I worked in a startup that did an IPO. It went IPO in March.
Oh wow!
Of 2000.
What sort of startup was it? An internet startup?
Yeah, it was an internet startup. It was called ImproveNet. It was providing, I don't know if you see these commercials on TV about Home Advisor, which they help you find a contractor. We basically invented that concept.
Oh, like Angie's List or something like that.
Yeah. So we were kind of the first one to do that.
Oh wow.
I was a very early employee. And then within 4 years, the company grew from like five. I joined when we were just 3-4 people. It grew from 4 people to like about 300 people in 3 years. They changed the management and all kinds of stuff. And, I did all of the website and the computer systems.
So that was a financial win for you?
No, it wasn't, because it went out on March 2000, so it didn't come out at the right time. So it was for one very brief moment. I was rich, but then you can't sell your stock, and then basically within a week the stock went from like $16 to like one. It was March of 2000. The bubble had burst, and the stock went down to like $1, and just like everybody, their brother basically lost money.
Oh wow.
So nobody really made money out of that. By the time I could sell it, it was like 10 cents or so, 6 months later. So nobody really made money out of that company. It just came out a little bit too late.
So then you ended up on your feet though at Goldman, is that correct?
Yeah. So after that, I moved to New York. I decided to go into finance, and then I worked for a few years at Bank of New York. Again, in a place where they invest in hedge funds. It's called a fund of funds, one of the oldest one in the industry. Then from there, I went to Goldman. I was kind of technical architects at Goldman for the merchant banking division. So I kind of oversaw a team of people there and ran basically their technology systems for a few years. And after
that's a big move. Going from California to New York City is a big change, huh? Big culture change.
I like New York. I mean, once I came here, I really settled in. I'm kind of a East Coast guy now.
So you're in Fairfield right now, is that correct?
Yeah. This is a town, just a few, about an hour north of New York. This is kind of the suburbs. So at some point we kind of bought, had kids, bought a house up there, and then at that point I moved to RBS, which was a little bit closer to, it's in Stanford, Connecticut.
I used to live in Wilton. I lived in Wilton for.
Oh, you did?
Yeah,
oh, wow.
I lived in Wilton for 5-6 years.
Oh, wow.
And
it's a nice place.
So when I think of Fairfield, we used to go to the Marcus Dairy. There used to be a car racetrack down in Fairfield that we go check out, and there was like the Harleys down there. And
right, yeah.
My family lived in Ridgefield also for a while, so
sure.
not too far away. And Stanford was nearby. My uncle was in Cusco, but yeah, you're not too far from the Greenwich suburbs and all the Greenwich is like the Beverly Hills of the East Coast or something like that.
That's right. It is. Yes.
So yeah, that's amazing. It must have been amazing working at Goldman and Bank of New York. What was that experience like?
Yeah, I mean, Goldman is absolutely a fantastic company, and I know it gets much maligned, but the people that work there, they're outstanding. I think it's it has a it has a very unique culture of consensus. Of basically you don't do anything until kind of everybody approves and all of your issues are resolved. So it's a very unique culture in that way. A lot of other companies, people just kind of do stuff and they don't think through all the issues necessarily. Whereas in Goldman, that is very rarely happens. They're just a very consensus culture. So usually everything gets worked out before they move. So they're a little bit slower, but they're steadier, and that's why they have survived so many different financial crises. They have excellent risk management operations. The excellent technical teams. I mean, this is by far the best place I've ever worked at. And a lot of the people that go there, they do prepare you for government service. So it is from the very beginning a government sucks. It is tough to get in. You're expected to do really well, and you're expected to kind of one day move into government service. So it's it is everything that they say it is. Now, all the richest people in America have their money there. If there's one company that's going to be the last company to fail, financial company to fail in America, that's going to be Goldman Sachs. Because if Goldman Sachs fails, that means America fails.
So you came in sort of doing the programming stuff?
Yep.
Were you always interested trying to push to just go into the trading world, or were you sufficiently challenged with the programming, or how did you feel about that?
Well, I mean, I don't consider myself a trader. I consider myself an analyst.
Okay.
Even what I do now we have kind of, we're starting to kind of manage money. Black Peak Capital is I've become an RIA over the last couple of years, and
Okay.
we're starting to open a practice to manage money, and we're managing some people's money. But at heart, I'm an analyst. I crunch data and try to make sense out of it.
So you were at Goldman, and then how did you get to Black Peak Capital?
I mean, just to explain,
Yeah.
I know how to program. I know 10 to 15 computer languages, but to me, there's a lot of people that are really in love with technology. I'm not in love with technology itself. I just view it as a skill set and as a tool that allows me to do something. In this case, determine what the right pricing for thing is. But in order to get there, you do need to process data from different sources. You need to crunch it, scrub it, do all kinds of things. For that, computer skills helps you.
So you see it as a tool to
Yeah, and I think going forward for anybody that wants to get into finance, I think this is going to be a prerequisite. Knowing computers is going to be increasingly. I mean, when I started, you had people that were financial analysts that didn't know anything about how to query data or how to get data. Right now, if you want to become a financial analyst, you have to have, you need to know a couple of things. You need to know SQL. You need to be able to know how to get data, how to massage it, to how to process in Excel, how to write custom functions in Excel. You don't need to have programming skills to be a top level financial analyst. And in a lot of the shops, or you need to know Python, a language that allows you to very quickly crunch data. These are required skills now.
I mean, it seemed like for a long time, financial analysis had a really bad name of just somebody who rubber stamps a stock or something that a brokerage is pushing. And it seemed like things changed about, I don't know, maybe like 10 or 15 years ago, things really changed in that industry. I'm talking about just the specific industry of like recommending stocks and that sort of thing. It seems like it's evolved a lot in the last few years.
Well, there's a couple of there's a couple of kind of things in that. So if you're talking about like bank analysts, basically when you talk about the big banks, and when I was at RBS, I ran kind of the I was on the institutional research team. So they have, they don't have a lot of flexibility. The analysts at the banks are all very smart people, but they cannot really, compliance doesn't allow you to kind of make big calls, right? So let's take the S&P 500, right? Like if you look at the S&P 500, every year people say, oh, it's going to be up 8%, right? I mean, just across the board, everybody says 8%. And if the previous year was a good year, they say, oh, it's going to be 10%. They add 2-3% to the average. Or if the previous year was a bad year, or they have some reason to be cautious, they say, oh, the returns are going to be low. Returns are going to be 5%. You never hear Wall Street analysts say, oh, this is going to be a 25% year for the market or a 20% year. You never see them say this is going to be a negative year. I mean, you're going to be hard-pressed to find an analyst, even in 2001, with the economy in the middle of a recession, or 2008, that ever gave a negative market outlook. The reason is for compliance. They don't want to get sued by over-promising or under-promising. So they stick to plain vanilla forecasts. Specifically in the S&P 500, I kind of like to point that out on Twitter, and I deride them all the time, is because if you look at the distribution of returns of the S&P 500, 60% to 70% of the time, the returns are either above 15% or negative, right? I mean, very, only 25% of the time are the returns, around 8 to 10%. So 75% of the time, these predictions are not going to be true.
They're wrong. Yeah.
They're going to be wrong. Just the way that, the VIX is 20, that means 20% variability of returns. On average, an S&P 500 year is not average. That's that's the reality of it.
Well, I find it fascinating because I come from a background I was a pit trader. We we most of us just had a basic college education, maybe economics, and then we learned how to trade in the pit. We learned how to make markets. We learned how to look at historical volatility graphs and all the mechanics of how you trade on the floor and in the pit and whatnot. But I never really understood what you guys were doing. That's why it's interesting to talk to somebody who's actually from the other side of things. So what do you do like in average day, week, or month? What's work like for you? Do you have like what are the sort of projects that you focus on?
So basically, I either I improve the reports. I introduce new indicators all the time. I introduce new reports daily. So I kind of keep I keep developing kind of new ways to look at things. Once every couple years, I'll have a couple algorithms that basically help me with my analysis and help guide investing decisions. I improve those analysis, improve those algorithms. So, for example, this year I have to, change my algorithms because we saw something that never happened before. So it does change basically the expected return based on historical backtest. This year is going to rewrite some of the algorithms. A lot of people want me to kind of rewrite the algorithms as things are happening, and I'm generally unwilling to do that because they don't know what the exit is going to look like. And usually the exit paints the overall expected return, right? I mean, if you make 40% over 6 months and then, in one day you lose 40%, and there's no way for you to predict it, the expected return is still zero. I mean, the problem with these trades is you cannot get out the way with the S&P 500. I mean, you can open minus 30% overnight, and you have no chance. You have no chance to put stops and to get out of it in a regular fashion.
Why does when I look at your name on Twitter, it says LTC behind your name? I'm assuming that it refers to Litecoin.
Yeah.
Mm-hmm. What is your firm's relationship with the cryptocurrencies?
Yeah, so I'll so the cryptocurrencies I kind of started kind of covering them. I mean, I've been covering them for basically for a few years. I wrote a white paper when Bitcoin was, I got interested in it around the Cyprus crisis in 2013, like most people in the financial world. At that time, I bought a bunch of Bitcoins, a bunch of Litecoins. I tend to buy physical things, so I have some Cassius coins. He saw these physical coins that you see on TV. He was subsequently shut down. But basically, their coin, which inside of it has a key, a digital coin. So at that time, I wrote a thing about Bitcoin because I kind of wrote, I did an investment analysis on it, like I do for everything else, like I do for the S&P 500 and for the VIX. I did an investment analysis for the Bitcoin, whether I should get involved in it, what is its potential. So I did an analysis. Basically, I compared it. What would be the price be if Bitcoin was a store of value like gold? What would the price be if it's a payment network like Visa? What would the price be if it's a currency like the US dollar? What is its fundamental valuation? How much does it cost to mine a Bitcoin, right? So what are all these parameters? So I had a pretty good idea of where the price could go. And so I kind of bought them. And I don't trade it actively, but because of my experience with computers, right? A lot of my clients, they kind of ask me about them because I can explain to them what they do and how they do it, and how they operate. And so they're really a big mystery to a lot of people. This thing we have never seen before. I mean, the concept of a distributed network was kind of, has been around, at least for me, since like the early 2000s. People wanted to kind of make these kind of, we used to call it a universal situation, kind of like this kind of a service that would kind of execute any kind of program that you give it. So people had all kinds of crazy ideas. It was called grid computing at the time, right? So you basically can go to all the computers and you can use them to do stuff. And basically out of that kind of philosophical kind of movement, I think at some point Bitcoin got born. There were papers about electronic currency. There's one paper, I think it's called How to Make a Mint, which basically describes the architecture of Bitcoin, written by NSA cryptographers. That's why some people think it's actually Bitcoin is a U.S. government creation somehow that's gone rogue. But essentially, this guy, whoever he was, the only addition he made to that was to come up with an incentive structure that would allow this network to exist. So all the miners that mine the coins, that they get paid to basically run the computers. The reason why this exists is because there is a financial reward for it. So people are incentivized to run on a computer, and to run a computer that takes in electricity and creates a Bitcoin, because then it has value. So really the only kind of bearish scenario for Bitcoin is, and that's what happened in 2013, is if the cost of the Bitcoin goes below the cost of mining it. At that point, all the miners are forced to sell because they have to pay electricity fees, and then you have a big drop. So the cost to mine a Bitcoin at the time was about 800. Now it's more complicated and much bigger computers, but also mining has moved from the United States, where electricity is 15 cents, to China, where it's 7 cents. So the cost has gone down because of that, but it has gone up because of the increasing complexity of the cryptographic algorithm that's being used to certify the uniqueness of these coins. So
now, somebody threw out the number of $1,500 a coin to mine them recently. Is that in the ballpark?
That's right. It's about $2,000. $1,500 to $2,000.
Okay.
Now, the interesting thing is that basically there is now a movement to. There's a company called Blockstream. They're one of the originals. They're making satellites. So what they want to do is they're going to put up a satellite in space that just mines Bitcoin. So they're going to put up they're going to harvest electrical energy from the sun, which is much stronger in space. It's going to cost them nothing, apart from building a satellite, right? And they're going to beam Bitcoin. So at some point, the cost of mining a Bitcoin is actually going to go dramatically down, right? So the cost of mining can go from China, it can get moved to Saudi Arabia, where the electricity cost is even lower. And then after that, you're talking outer space. So that that's like not a long-term concern for me. A lot of people are concerned about the electricity that's being consumed by the network. I think that there's a technical solution to that problem, a long-term technical solution to that problem. And now, the price is 20,000, whatever it is. I mean, until it gets to that price of 2,000, you don't have, the miners can just hoard the money. And they don't have to, they have to sell only a very small portion of it to finance their operation. So the kind of the bear market scenario that was there in 2013 is no longer present.
So there's only like a limited, like the actual coins in circulation is a lot less than the total coins out there. Is that
right?
Part of it? Could you explain, like, for my mother who doesn't know what Bitcoin is at all, could you explain in just a couple sentences what is Bitcoin and how does it work?
Bitcoin basically it's a bank account with a balance in it, right? So there's a bank account with a balance, but instead of trusting the bank, you're trusting a computer system to validate the balance and to make sure that your money is always there. And when you do transfers, that network also enables the transfer, and that network is being run by people, miners, who are getting paid to run it. So they have every financial incentive to keep the network up. Now, why is this network reliable? Is because it takes an enormous amount of computing power to run it. So, some estimates of the amount of computing power required is like 1 billion desktop computers. Let's say it's not 1 billion, let's say it's 200 million computers. But basically, it's a whole bunch of people running these computers, whether they're in China, whether they're in Russia, whether they're in Europe, whether they're in the US, whether they're in South America, right? They're running all these computers. And so long as people cannot get 51% of the electrical power, they cannot really revert the uniqueness of the coin. So basically, they cannot really mess with the coin. So the coin is unique so long as the electrical consumption is big and spread out around the world among different actors. So basically, the distribution is what you can kill it. It's kind of like, in all the movies that we watch, there's always some kind of a central computer that you attack, and then all of the evil guys fall down, right? Well, this is the opposite of that. You just can't kill it. There's no single place you can kill it. So it just keeps living on and on. And there have been multiple attempts to kill it, So a lot of it you have to trust kind of the cryptography of the solution, but there's a lot of very smart people. There's tens of thousands of software developers, there are tens of thousands of hackers that have tried to kill this, to hack it, to reverse it, to mess with it, and it's year 10 now, or next year is going to be year 10, and they haven't been able to do it. So that in itself is a testament to its power. So what is a Bitcoin? So how do you value a Bitcoin? I mean, I see a lot of confusion. There's a lot of people that are going to go crazy that the price has gone up and they cannot explain why. Basically, one of my models is that I used to value Bitcoin is as a store of value like gold, right? Basically, a monetary store of value, a monetary commodity. And Bitcoin price seems to be following that path, right? So basically, if you think of it, if Bitcoin goes to 10% of all the gold's world value, which is about $8 trillion, Bitcoin price would be about $50,000. If it goes to 20% of all the gold value in the world, it's going to be $100,000, right? If it goes to 100% of all the gold value in the world, is going to be $500,000, right? I mean, the numbers can get astronomical just because it's a limited coin. Now, a lot of people say, and rightfully so, I mean, Bitcoin is not a good payment network. It's not good at what it was intended to do, right? It's supposed to be a payment network, right? But right now, the confirmation times, they used to be 15 minutes in 13. Now they're like 45 minutes and they're growing bigger, right? And people don't want to make changes to the code to make it faster. So basically, Bitcoin becomes kind of this network where you can put money in, and it's very difficult to take them out or to transfer them around. So basically, it becomes like gold. I mean, people, there's a lot of gold in Fort Knox. People are not moving that gold around, right? Like gold's immovability and lack to deliver it has not stopped it from being a monetary asset, right? So Bitcoin in a lot of ways, like actually the slower it becomes, the bigger store of value it becomes, right? And that's why its price, which followed the payment network model up until recently, as Bitcoin becomes slower, it starts to become more of a store of value, and then the markets are starting to view it this way. So that's why the price has gone up.
So did you buy a lot of Bitcoin and other cryptocurrencies at some point, or are you accumulating them now, or do you sell them?
I bought them. I mean, I bought them when they were when it was $250. I bought a bunch.
Oh, nice.
So I bought some when it was 800. Then when it went to 250, I doubled down because it's at that point where basically there were some of the miners in America started bankrupting, and I'm like,
that's so it got up to 800 and then it fell back down to 250. Is that what you're saying? Okay.
Yeah. It was for 250 for 2014, 2015.
I had some at $1 and then I lost my wallet, and so I was thinking, oh, it's all over at $1. So that's me kicking myself
Yeah.
Fortunately, some of my subscribers on my YouTube thing actually gave me some Litecoins recently, so
Oh, that's
I'm
good.
happy for that.
Yeah, congratulations.
But so what do you see happening with this in the next 5 years? You have
So
a
so so
prediction?
so Litecoin, for example. So why I have LTC on my thing is, and why I particularly like Litecoin, is basically there's something to understand about basically about payment networks is that once you establish a payment network and once people write code on top of it, like as a person who's written code, I can tell you that basically when you're in a larger organization, once you write the code never dies, it never gets deleted, it never gets replaced, right? Because basically you have, 5 or 10 guys, paying high salaries. They go and they test the code, they put it together. Let's say they spend $1 million or $2 million to write a piece of software. I mean, no company is going to spend that $2 million again to do the exact same thing, right? So once you write something, it stays there for a long time. So all the payment networks basically, once people start to use them, they don't use, people are like, oh, people are going to start using something else. That's a good concept in theory, but it's not a practical concept because in practicality, people have to write code and test it to use that new network, and it costs money. And if they have something that already does it, they won't do it.
Yeah.
So they kind of stick with their existing network. So that's why Western Union to this day exists. That's why PayPal, never going to get replaced. That's why Visa and MasterCard always get bigger. This thing, there's going to be bigger market. It just basically each generation of people starts to use a certain payment network. And, the millennial generation is going to start to use Bitcoin and Litecoin and so forth. And from that's where its staying power will come. Now, here's the problem with Bitcoin. Now, all these cryptocurrencies, because they require more processing power over time. This cryptographic algorithm is ever more difficult, and it requires ever more electricity. So, yes, they're going to get more expensive in time, but basically, at some point, if you were using Bitcoin for payments, you will no longer be able to use Bitcoin for payments.
It'll
right?
be too expensive.
Well, the price of the Bitcoin doesn't, or the volatility doesn't matter a lot because people just switch it to the currency.
It's just divisible. Yeah, okay.
It just as a transmission mechanism, but the problem is that the slowness of the confirmation times, right? So people are not going to use it as a payment network, right? So people are right about that. The bearish analysts say that they're completely right. It's going to become less and less useful as a payment network. But people have built, there's merchant sites that use Bitcoin to pay and so forth, or to transfer value. They have to use something else. And when that, basically, if you have two queues and one queue gets jacked up, all the processing has to go to another queue. That other queue, the most similar system to Bitcoin is Litecoin. It's basically identical to Bitcoin, but it's faster, it's better upgraded. So eventually, Litecoin, it's going to be like we already saw a sudden spike, but the spike is going to be even bigger when a lot of the money just overnight goes to Litecoins as a failover.
Right? Yeah, that spike like last week where it went from 150 to 400 in one day. That was a big Litecoin.
Yeah, that's basically a bunch of people that are like, okay, Bitcoin is too slow. We got to go to Litecoin. And Litecoin provides you the same interface. It's very easy to port the code over. Now, if you have to do a similar thing for Ethereum or Ripple or any of the, they're completely different interfaces with completely different rules, right? They have completely different markets. That's not kind of the investment case there. They're a completely different investment case. But that's what I think. That's why I like Litecoin. In particular, the other reason, is kind of the civil war. That kind of actually the reason why you had this big spike right now was basically Bitcoin had come to a split, right? So it was either going to move towards Bitcoin Cash, which is basically has a bigger. I don't want to get into too much details, but basically it's going to allow processing to be faster by making a bigger block. And the counter argument to that is that will centralize processing. You need bigger computers and richer people to run it, right? And a part of the Bitcoin community is these kind of libertarian anarchist developers, right? That they
decentralize. They don't want anybody to be able to run it.
Yeah, they want to run it on every computer. And Litecoin's algorithm actually makes it a little bit more difficult to centralize the mining capacity and allows little guys to. So it has kind of a grassroots love, so to speak. from the developers.
What about all these other currencies? There's hundreds of them now. It seems like. Do you think that do you think that they're going to disappear at some point, or is this just going to grow up more and more and more?
No, I mean, obviously there's more money being thrown into the space. I really, I know how big Bitcoin can get, and I don't know the other ones. Ethereum, for example, is a smart contract language, which basically means, Ethereum is a completely different thing. Ethereum is supposed to be a distributed computer that provides you computing power to do, to run applications, like, to run a computer game like this CryptoKitty game, or eventually maybe people build a Twitter that's uncensorable on it, that cannot be shut down by governments. So it has a tremendous promise. I don't really know how to value it. It just the ambition is so big. I don't even know how high it can go, or how to value it, to be honest with you. So that's Ethereum, right? Ripple, on the other hand, Ripple, for example, is the one that's most likely to emerge as a payment network. This one doesn't have miners. It's a private company that has a cryptocurrency. They've been doing this for 20 years. They're a Silicon Valley company. A lot of the banks, like, in Europe, Bank Santander, they're all using Ripple to do their transactions. So when people say blockchain, right, Ripple really is the blockchain that banks use currently. Like, the banks are not using Bitcoin, they're not using Litecoin, they're using Ripple, right? So Ripple has that investment case as the real kind of blockchain payment network.
And Ripple's gone up a lot too now. I looked at it; it was like 75 cents or something recently, but it's gone up a lot in the last few months. Also, I think it seems like if you just threw a dart, you'd make money recently on these.
Yeah, I mean, basically, institutional money is investing in it. Obviously with the futures market. So basically, what will happen to Bitcoin is the Bitcoin will stay there, and you're gonna have futures being traded around, right? Just like gold. Eventually, you're gonna have futures for Ethereum. You probably will have futures for Litecoin, because basically Litecoin is like silver to Bitcoin's gold. All of depending on the adoption, these have much further to go up. Now, if I were to invest, you have to invest with the idea that this can go down 70% or 80% at any point in time. I would much rather buy it like a 30% drawdown. I will scale into it slowly. I would not put a lot of money. I mean, the irony is, like, I've put maybe, like, I don't know, $5,000 into this now. Like, it's more money than I can count, so to speak. It's a huge part of my savings all of a sudden.
That's great. Yeah, that's great.
Do I sell now? I mean, I don't know if I would sell right now, because what we're seeing right now is a repricing of the usage, and in this case, you see it in the actual price. Like, you have a network, like, Microsoft starts to get used, and eventually the stock price will go up, right? People start to use it, and millions of people start to use it, and eventually that translates into earnings, and then eventually the the Microsoft price of the company goes up a lot, right? In the case of Bitcoin, I mean, if people start to use it, you see it in the price. If people stop using it, you immediately see it in the price. It's the type of thing where kind of the engineering mechanics are, you can see it through a price, in real time. It really is an amazing thing.
Do you personally invest in VIX type things?
Yeah, I do.
Okay.
Yeah.
What would be your preferred, like, if somebody had $1,000, and they have got a year, let's say 3 years time span. I guess I'm going to predict what you would say. You would say to sort of trade it, but what would you recommend that they play? Like, would it be XIV? Would it be ZIV?
So in a volatility space, I would I would generally recommend only to do short volatility. So long volatility is a very active trade. It's a very difficult trade to kind of, like, if you have a couple of years of long volatility, long volatility is going to be a good trade to be in, but it is subject to huge drawdowns and huge risk. And I would not recommend that, for buy and hold to anybody, or for hedge, or, I would just not recommend it. For any regular investor, I would recommend XIV. For I think people can put some part of their savings that can boost their S&P 500, but only after a big VIX spike, only after a bear market. Basically there was a time to invest in XIV, in 2011. Maybe a little bit in 2005. But you don't invest in XIV kind of as a buy and hold investor when the VIX is at 9. I mean, you just don't, regardless of the amount of money that's being made.
So you need a spike of some sort to enter.
Yeah. So when you have a drawdown in the market, it's like it's very hard to kind of tell a rule. Oh, it goes to 20, then you buy. If you have a bear market that lasts for 2-3 years, you don't want to be in XIV. At some point, the bear market is going to end. Then you can be in XIV and you can make returns that beat the market. But generally for investors, for your mom, it would be XIV, and I would not invest today. It would be like during the next recession when the market is down 50% and the world is going to have a handbasket. Then and the XIV is 50 cents. So then we'll put $1,000.
So would you recommend somebody buy a S&P index fund, the SPY maybe, or that's the ETF obviously, but
yeah, I mean, I basically, I trade my wife's money, so with my wife, I'm basically treating her as as your mom, let's say. I want to be extremely safe. So with her, I do invest in the S&P 500 again. If the VIX is on the way up, where the money is in cash, right? And then we're waiting for volatility to become realized. Then when the volatility realizes, then you enter and you've reduced a lot of your drawdown risk, right? If you enter 30% down or 20, the most you can go is another 20%, another 30%. You don't have, you're not going to cut your money in half. Basically, when volatility is realized, when the risk is realized, it's a much safer entry point. So that's when we do it, and then basically when the VIX goes to lows as it is now, and sometimes it can take a very long time to get to these lows. At that point you get out, sometimes a little bit earlier than the peak. But basically, the way we view it is kind of as the market goes higher, as the valuations don't make sense. These are money that you make, like, for your mom, that you cannot keep. You want to only invest when you can keep the money, because you basically don't know. The market can be down. You can wake up tomorrow, it can be down 3%. I mean, you saw what happened with the Flynn. Just a week ago, right? With the Flynn news about Trump. The market went down like 50, 60 points in 15 minutes. The data feeds did not work. You could not execute trades. The broker, they managed to save it. They've saved it a couple of times this year. Eventually, they won't save it.
But that could have been a disaster. And August was pretty sketchy too. We went from UVXY went from 28 to 43 in August. That was a little sketchy time period. What about
there's a lot of dip buyers 20 points below the index. There's no dip buyers, from 20 to 100 and 200.
What about VMIN? Do you like those ones? The shorter term type investments? I guess that corresponds more to the VXST sort of. It's like, it's 20 days as opposed to 30. I think VMIN's investment horizon. So.
Yeah, VMIN is a little bit closer. My view on VMIN is, it is basically, it is a tool that was created for professional investors who want to get more volatility out of something. They want to get closer to which is highly volatile. And basically there was no major bank that would create this index. That's why you had a startup create it, because they wouldn't touch it for the reputational risk, right? You just even getting like the XIV and the VXX are already crazy leverage. VMIN is even more so, only 10% more so, but 10% is a lot of money in a catastrophic event. And so they wouldn't touch it, and that's why you never had this product because nobody wants to get closer to the VIX. So I would not recommend it for any for regular investment.
Yeah,
not ever. It's a professional instrument.
How about how about the Bitcoin? Do you think people should? Are you a buyer of Bitcoin here? Do you think if you're a young person maybe and you want you have a good appetite for risk, do you think Bitcoin's going to go higher? Where will it be next year at this time, do you think?
As an investment right now,
I know I'm putting you on the spot a little bit here. You can't predict the future.
Yeah, I mean, this thing, I think it's, I mean, Bitcoin has a lot of upside drivers still ahead of it. There's ETFs that are going to get approved on top of the futures, right? You are going to have futures in Europe. You're going to have opening of regulation in, it's already accepted in South Korea, in Japan. I mean, country are going to continuously adopt it. Each one of these is an upside risk to the price. In other words, the price is going to go up. Eventually, China may open to it. That's going to be a huge upside risk, right? A lot of people say, oh, regulations, they're going to come down on it. They're not going to come down on it because, the U.S. central bank does not want to print money cheap in the U.S. dollar, right? Bitcoin, all these out currencies, they're basically money out of thin air to expand the money supply for the central banks. I mean, it's like a gift that came out of heaven for the central bankers. So the first thing to understand is there's a bit license law in the United States. It's already regulated. All the companies that you're using are already regulated money transmitters. They follow your like opening an account at Coinbase is the same as opening an account at Chase Manhattan Bank. It's
now. Why do you say it's
already regulated?
Why do you say it's a good thing for the banks, or the central banks? You just said it's something from heaven for the central banks. Why do you say that?
Well, because basically, what you want to do is you want to, what central banks do is they expand the money. I mean, they have only one job, which is to expand the money supply, right? And they're usually under pressure from fiscal conservatives not to expand the money supplies who want some kind of a currency that's limited, right? Well, now you have Bitcoin, which is a kind of a currency and store of value, and you can move money around. And basically, when you get new altcoins and money goes there, it basically you're creating new money. Like if you for example with Bitcoin with these forks, right? When you create a fork, you create a whole new network which is powered by computers, and that network has value. And you already take the existing coins, and they're already there. You get it's not a dividend because dividend subtracts from the value of a company. This is basically an addition of value. It's like a new product. You're expanding the money supply, and kind of at the no cost of the banks. I mean, they don't take on more debt or anything.
So who loses from this? Gold price? Does gold lose? Does
gold is the big loser. I mean, gold price would have been 2,000 by now.
What about like startups, like the speculative money? Like a lot of the speculative money out there is going to Bitcoin right now. So are I don't know, tech companies losing out, startups, market.
There is this concept, a lot of people were very kind of hot, whole concept of a blockchain. What really people were excited about at the very end of the day is the concept of a distributed database, basically a database where you can put stuff and everybody can use it. There's other products that are much better than Bitcoin to provide a functionality. And companies that do that. I don't really see, everybody says blockchain, not Bitcoin. I think that's to me personally, that's the stupidest thing ever. They're just, Bitcoin is Bitcoin, store of value. That's the only value. And the blockchain, because the blockchain capability are minuscules of the Bitcoin network. The distributed database capabilities of Bitcoin are you're like playing on an Atari computer. It's it's a joke. The Ethereum has a better, it's much more sophisticated for that. But any blockchain applications or anything, they're not going to be on Bitcoin. They're not going to be on Bitcoin. They're going to be on Ethereum or other cryptocurrencies.
Well, listen, I love your Twitter feed. I can't engage with you fully in politics because I've taken a stance now that I've got to stay a little bit politically neutral to try to help grow my channel so that I don't alienate half the world. But I love listening to your messages every day. You always have some interesting stuff to say, and I was very excited to invite you to come on this program because you know a ton of stuff about volatility, and I really want to highlight your YouTube videos because just because they don't have 10 million views doesn't mean that people shouldn't be looking at them, because you have some of the best information out there as far as I'm concerned, not only on the VIX but on the market in general. So I will put a link to your videos at the bottom of this.
Thank you.
I always have people, I spend a lot of time on StockTwits every day talking with newcomers to volatility, and they ask me the basic questions: what's Contango? How does this work? A lot of them start out getting, they heard about UVXY. They thought, wow, I can time the market for a crash and make $1 million. And they slowly start losing money, and they come around to the fact, well, maybe it's better to be the casino selling the lottery ticket instead of the guy buying the lottery ticket. So, and I always need a place somebody's to help educate them, because with 140 characters, it's hard for me to explain the ins and outs of the VIX.
I mean, it's complicated. They can kind of go do the various block if they want to get more serious and kind of learn how to use the various indicators, or learn what to look at and how to look at it. That's what our subscription service is for. People can subscribe. They can be there for a few months, and they can learn about how we use it to trade it. And a lot of people on my site, they read my analysis. They look at the data that we provide. They look at the reports. I have a sample portfolio that I trade. I send signals for that. I have the algos, but a lot of people don't actually. These are very, very simple. Oh, buy it now. It's a good time to buy, or it's a good time to sell. Right? They're very kind of rule of thumb type of algorithms and advice. People actually trade complicated option strategies, or people get a lot more complicated, but they basically base it off of the indicators and the analysis that we provide. So if people want to get more involved, they're obviously welcome to subscribe.
I think it's. I think I know a lot of people that have been very successful in this trade and have financially have made a lot of money on it, but they're always looking for ways to increase their knowledge. And I think your website is something that would be of interest to a ton of people, and they just don't know about it. So hopefully they can find this video from me, and it points them in the right direction, and I think it would be a great benefit to them. I've checked out your videos on how it works, and I think it's of interest to a ton of people that I talk to every day. Because and it comes along with a caveat, like so many of these other videos, that this is a risky trade, and just because this year it's been great doesn't mean that there isn't risk attached to it. Because the stock market is the toughest place in the world, and anything has a risk, of course.
Yeah, the way the market works is it pushes trades to the maximum. It's like a huge pendulum, right? It pushes trades to the maximum. Sometimes to extraordinary places never seen before places. That's what we saw this year on the short volatility side. Then at some point the pendulum is going to swing to the other direction, and it's going to last a lot longer, and a lot farther than you think. So that's just how markets are. They you can make the same money the same way for a very long time. Well, no matter what the asset class, it just when you think about it, physically not stable. Like the same people, the same group of people cannot make money, and there's if the other side is losing money, at some point they're going to run out of money. So at some point, there's just no more money.
Well, I mean, that's the way trading is you find an edge. You find an edge and it works for a little while. Hopefully for some time you can make some money, and then you look for the next edge you can find.
Yeah.
Seems to me. But thanks so much for spending a little time with me today. And I'll put your information for your Twitter and your also your website down below. And I always enjoy your tweets and your views in current events and politics, as well as just the volatility.
Thank you so much. Thank you for inviting me. It was a pleasure, and yeah, I'm glad you enjoyed it.
Yeah.
I have a tendency to make a lot of people mad, on either side. Like I have a rule: if I walk into a room and I haven't pissed off everybody, I haven't done my job.
That's great. That's awesome. Well, thanks so much for coming on, and stay in touch with me, please.
Thank you. Absolutely.
Okay, thank you.
Mm-hmm.
Okay, so I'm